Hi guys, today we are going to discuss portfolio management, that how it works in investment banking and how it relates to your CFA level 1 curriculum, what is covered in the curriculum for you guys in level 1. So basically I can give you a brief idea first to begin that there are certain asset classes which you may are familiar with, like stocks, bonds, commodities, real estate, and US treasuries, and some reserves like cash and bank, like mutual funds. So, what the investment banker, the portfolio managers mainly do, they diversify the risk. They diversify the risk of investments by allocating the funds into different asset classes. Like there is an investment bank, a large investment bank in the US called BlackRock. So these kind of investment banks, they have portfolio managers. What they do, they allocate funds into different categories of investment avenues. For instance, 30% in stocks, 20% in bonds, 10% in commodities, alternative investments, 25% in mutual funds, and some reserve in cash so that when there are opportunities, they can take the cash and invest in the opportunity. Or if the investor whose money is being invested, he needs any urgent cash, they can give him the cash without divesting their investments. There are types of investors based on which the asset allocations are done. Some investors are risk averse, some are risk seeking, some are risk neutral. The risk investors, they don't go for risky assets, they go for returns in which if there are two asset categories and they're offering the same return, but one is risky and other is less risky, so they will go for less risky investments. Risk seeking investors, they go for high risk asset classes like equities, like alternative investments, commodities, and other investment classes which have high risk. And the risk neutral investors, they don't have any preference regarding risk perspective. They invest regardless of their risk categories. They go for the neutral returns, the normalized returns. Then in your syllabus, there is a concept of capital allocation line, which says, and which depicts that if we combine a portfolio of risky asset class along with risk-free asset class, and we plot it like the risk on the x-axis and the return on the y-axis. And if we draw the lines, then these lines represents capital allocation line. So with respect to portfolio management, there are certain aspects that individuals, like other insurance companies, like uh, endowment funds, they approach the investment managers, the portfolio managers, and describe their situation. The portfolio managers then start writing their preferences in IPS, investment policy statement, which we know that it is a document where risk and return objectives are documented for the investors, which states that this is their risk appetite and this much return they're expecting over a period of time. They state their objectives and they describe their risk, and as per these two factors, they start investing their funds, right? Okay. The next concept, which is relevant to portfolio management is active portfolio management and passive portfolio management. What is active portfolio management? There are certain fund managers, portfolio managers, which prefer not to invest in the index. They don't want to follow what the index is giving the return. They have their own strategies. They think that they can fetch alpha, the return, access to the normal portfolio return of the index by their skills. They can identify stocks with high returns. So they don't copy the composition of the index and they go for different weightages of the investments in their portfolio. And passive portfolio management means they follow the index and they almost more or less reap the same returns like the index is giving. As you guys are familiar in your prior education or in the prior concepts in equity investments, that there are two categories of risks in investment: systematic risk and unsystematic risk. Unsystematic risk can be reduced by diversification, and systematic risk stays there. These are the two concepts that I need to deliver you guys. And then finally, we are approaching towards capital asset pricing model, which you guys know. It helps you to calculate the cost of equity once you have studied the weighted average cost of capital, which we use to which we use in discounting the free cash flows to arrive at net present value, or the pricing of the investment stocks. We use the discount rate of the company where cost of debt and cost of equity is used. Mostly in projections, the companies use 5 years data, forecasted data, and then they discount the present value, they discount the free cash flows, and to arrive at a single value, present value, and then determine whether it is feasible for the company, or in case of business valuation, they determine the price that this is the price that we are going to pay if they are going to acquire any kind of a business. And same goes for valuation of scripts. When some people like investment firms, research firm, they identify stocks and then they check that the valuation of the stock is undervalued or overvalued. They use fundamental analysis and then they arrive at a price by discounting and by using different valuation models, financial modeling, and then they compare what price they arrived at and what is the market value of the security at the closing date. So these are the basic concepts that I want to make sure that you guys understand with respect to portfolio management. Thank you so much. If you have any questions, please do ask in the group.